Welcome to Sophie Daddy's channel. Okay, let's dive right into this. The US stock market has been on an absolute tear, hitting one record high after another. But if you look just beneath the surface, you find a genuine mystery. Are we seeing a market that's just rationally priced for a whole new economic reality? Or are we all standing on a dangerously shaky peak? Today, we're going to play detective, investigate the clues, and try to crack this case.
And this right here is the multi-trillion-dollar question, isn't it? It's what every single investor, economist, and analyst is wrestling with right now. So let's start our investigation by looking at the raw evidence. You know, the kind of data that usually sets off some serious alarm bells.
Okay, so look at this. No matter how you slice it, the initial evidence looks pretty damning. The forward PE ratio, way above its 10-year average. And when you look at these longer-term, more sober metrics like the CAPE ratio or Warren Buffett's favorite, the Buffett Indicator, they aren't just flashing warning signs. They are literally screaming strongly overvalued. Case closed, right? Well, not so fast. To really get what's going on, we have to appreciate the environment we're in. We're basically investigating a crime scene that's taking place in rarefied air. We need to understand the unique characteristics of this market landscape before we jump to any conclusions.
And this slide right here reveals a massive clue. We're not really looking at one single market. It's more like a tale of two markets. You've got this tiny group of giants, we'll call them the Great Eight, trading at a super premium valuation, around 35 times their earnings. And then there's everyone else. The other 492 companies are trading at a much more reasonable, though still kind of high, 21.5 times earnings. This concentration is a huge deal, and it's a major source of potential risk.
All right, let's follow our first lead. We can't analyze this market in a vacuum, right? We have to look at the big picture economic forces that are creating the weather. And right now, that weather has been surprisingly sunny for stocks.
So clue number one, and maybe the biggest one of all, is the Federal Reserve. After fighting inflation like crazy, the Fed did a complete 180 in 2025. 2 rate cuts and ending its balance sheet reduction program, that sent a crystal clear message to the market. The Fed put is back. Just think of it like an insurance policy. It's this belief that the central bank will always step in to prevent a major crash. And that, of course, encourages investors to take on more risk.
Now, to really get why the Fed's actions are so incredibly powerful, we need to talk about this idea of interest rates as a form of financial gravity. See, when you value a stock, you're really just making a guess about its future profits and then pulling that value back to today's dollars. The interest rate is what you use to pull it back. With the 10-year Treasury yield around 4.1%, that gravity is just weaker. And that mathematically pulls the value of all those future profits higher, which helps justify higher stock prices today. It's that simple.
Now, inflation, this is a really tricky piece of evidence. On the one hand, a little bit of inflation like the 3% we're seeing is actually a tailwind. It lets companies raise their prices, and that boosts their revenue and earnings in dollar terms. But on the other hand, it's the market's biggest fear because it's still floating above the Fed's 2% target. It's this constant threat that could force the Fed to slam on the brakes and start hiking rates again, which would basically undo everything.
Okay, so we've looked at the macro environment, the weather, so to speak. Now let's get our magnifying glass out and zoom in on our next clue, the companies themselves. Are they actually healthy enough to deserve these sky-high prices?
And the answer, kind of surprisingly, seems to be yeah. Corporate profit margins are at a stunning 12.8%, well above the average. And what's so fascinating is that this might actually be the new normal. The economy has fundamentally changed. Remember those Great Eight companies? Their business models, asset-light, high-margin software and services, they now dominate the index. That structural shift, plus decades of lower taxes and cheaper debt, well, it creates a recipe for super high profitability that just wasn't really possible in the past.
And if those high profits weren't enough, get ready for this number, $1.1 trillion. Just let that number sink in for a moment. That is the record-breaking amount of money that corporations are on track to spend in 2025 just buying back their own stock. It's a staggering figure, and it's acting like a massive engine for this market.
So why does that trillion-dollar number matter so much? Well, for one, these buybacks provide a massive, constant source of demand for stocks. But more importantly, it's a form of financial engineering. By reducing the number of shares out there, companies automatically boost their earnings per share, their EPS, even if their total profit doesn't grow at all. It just makes their valuations look more attractive and directly supports their stock price.
So, we've looked at the macro clues, we've looked at the micro clues, but now we get to our final piece of evidence. And this is where the mystery really deepens, because it reveals this fundamental conflict in how the experts are even interpreting all this data.
Okay, let's unpack a key concept called the equity risk premium. It's actually pretty simple. It's just the extra reward you should get for taking the risk of owning a volatile stock instead of a super safe government bond. Right now, as you can see, that extra reward is a razor-thin 0.31%. Now compare that to a historical average of over 5%. This suggests investors are getting almost no compensation for taking on a massive amount of risk.
And this slide lays out the central conflict perfectly. On one side, you have the equity risk premium model. It looks at that tiny 0.31% premium and concludes the market is dangerously overvalued. But on the other side, you have the Fed model, which just compares the two yields. Since the stock yield of 4.4% is a bit higher than the bond yield of 4.1%, it concludes the market is fairly valued. Now, academics hate this model. They say it's like comparing apples to oranges, but it perfectly captures that there is no alternative logic that's driving so many investors today. So, after examining all the evidence from our investigation, the sky-high metrics, the powerful macro forces, the strong corporate engine, and these conflicting models, what's the final verdict on the case of the high-altitude market?
You know, the best way to describe the market right now isn't as an irrational bubble. It's more like it's in a state of conditional equilibrium. The valuations, as high as they are, actually make logical sense given the current conditions, a supportive Fed, decent growth, and those highly profitable companies. But, and this is a huge but, that equilibrium is incredibly fragile. It totally depends on those conditions staying exactly the same. There's just no room for error.
So, to recap, the bull case really rests on these four strong pillars. You've got a friendly Fed, a resilient economy with structurally profitable companies, that trillion-dollar buyback machine putting a floor under prices, and the simple fact that, hey, compared to bonds, stocks still look like the only game in town for returns. It's a really compelling argument.
But then again, the bear case is just as compelling. Those absolute valuation metrics from the very beginning are still flashing bright red. The reward you get for taking risk is historically low. Inflation is still the #1 threat that could knock the whole structure down, and the entire market's performance is dangerously reliant on just a handful of those great 8 companies continuing their spectacular run.
So we close our investigation here. The market isn't necessarily irrational, but it is priced for perfection. It's walking a tightrope, basically assuming that inflation will cool just right, growth will soften but not crash, and profits will stay high. And that leaves us with the final, crucial question to think about. In a world that is rarely perfect, what happens when the first gust of wind blows?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.